Hey folks, today is the start of our series talking about different types of loan products or credit facilities for commercial subcontractors. This is a really important series, and today we're going to talk about, at the top of the capital stack, we're going to talk about bank lines of credit, why they're important, how they work, what that means to you. So we'll kick it off. So generally, commercial subcontractors are not failing due to a lack of revenue. They're failing because of timing. You have to pay weekly payroll. You have to pay materials up front. Maybe you have 30 days terms on those materials, but you have to pay for materials before probably you get paid. You have to pay for equipment rental expense. But the reality is your general contractor or owner of the project that you're working on doesn't pay you for 30 days after you submit your first invoice. All the while, you already worked 30 days. You submit your invoice on the 20th. They don't pay you for another 30 days. So that's 60 days without cash. If it's 45-day payment terms, that's 75 days without cash. And then you got retainage all blocked up in there. Man, it's a huge cluster. So bank lines of credit, what they're used for really is to smooth out the timing related to this sort of construction industry sort of conundrum of cash being tied up on the job. However, they're not meant to actually help you scale the business or a reliable solution to help you grow extremely fast. What they do is they just smooth out the timing. So what problem are banks' lines of credit designed to solve? And excuse me here, I'm kind of referring down to some notes. It's used to provide like that short-term liquidity against your receivables. And the way they do that, guys, is they take your whole receivable sort of world. You might have 10 jobs, right, out there, and some of them might be work in progress, some of them might be done and the receivables still out there. And they'll take that whole receivable world that you have and create a borrowing-based calculation. So let's say you have $10 million in receivables. And I want to take a step back and just remind everybody, what is the definition of receivable? Receivable is a balance sheet line item. And in an accrual sort of scenario, it is recognized as revenue on your income statement. It's work you've already done, but not been paid for yet. So to put it another way, your accounts receivable on your balance sheet is someone else's accounts payable. So you also see accounts payable on your balance sheet too. That's what you owe your vendors, right? Well, your accounts receivable, you're a vendor to a degree to one of your customers, then that's their accounts payable. Anyway, that's neither here nor there. I kind of got off on a little bit of a tangent, but that's okay. So they take your whole accounts receivable world and they look at it and they say, okay, this company has $10 million in accounts receivable at any point in time. It's at a point in time, right? And then they'll say, okay, what portion of this accounts receivable, let's look at the aging of that accounts receivable. Okay, well, $7 million of it's current. Great, that's within the borrowing base. $1 million is 30 to 60 days past due. Okay, they'll probably consider some of that as well. And then the remainder is either in retainage or 90-day plus. They ain't considering that. They are considering that ineligible. So they do an eligibility analysis on those receivables, and then the bank, that is, they figure out exactly how they want to size a line of credit, right? So another thing that they do is they will create ineligibles if they're foreign receivables. I can't imagine many of you guys out there doing foreign contracts, but they won't count foreign receivables. Maybe some other, customer concentration is a great one. So if you have a customer that accounts for 50% of your accounts receivable, well, they'll count up to 20% of your total accounts receivable under that one customer to be eligible, and then they'll consider all the rest ineligible. Maybe they'll go up to 25%. Some more conservative banks will consider 15% customer concentration to be their upper threshold. So, okay, they did the eligibility calculation. So you got top line, gross receivables of $10 million, right? And then they considered the retainage, the ones that were really late, the customer concentrated parts of your receivables, and now you have $6 million, right, of eligible accounts receivable. Okay, then they do a second thing. They slap an advance rate on that. And they'll slap an advance rate of, call it 70%. So that's I guess out of $6 million, what is that, $4.2 million of an available borrowing base. Your borrowing base is the basis upon which you can borrow on. So you can then borrow up to $4.2 million on that line of credit. Well, when you have $10 million of accounts receivable and you continue to do more work and more work and more work, you can see how you, as a high growth subcontractor, can outgrow that line pretty quickly. Now, the way they size a line is not purely on your eligibility. That's just what your borrowing base is. That's what your availability is. But what they're actually going to do first is they're going to look at your whole company. They're going to look at your trading assets. They're going to look at what property you own, the value of your equipment, the value of maybe your home as the owner of the subcontracting company, your home, what's the value of that? What's your global cash flow? And they're going to size a loan appropriate to those numbers. And then they're going to look at your accounts receivable and do the exercise that I just outlined. Then they're going to look at that and figure out what's the appropriate size, right? So let's say they say, okay, he could have a $4.2 million worth of availability. Maybe we'll give him a $5 million line. Well, just because you have a $5 million line, your availability based on your borrowing base calculation might only be 4.2. So you're not fully drawn on the line, but you're fully exposed on the line as it relates to what your borrowing base is actually going to be calculated as. But also, let's say that you're not a super profitable subcontracting company. Maybe you're doing $23, $24, $25 million in revenue a year, which would show, based on $10 million in receivable, that you're turning your receivables about 2 to 2.5 times a year, which is not great. And then they say, well, they only have about $1 million to $1.5 million, or maybe $2 million in EBITDA. They're not going to give you a line much larger than max 2 times that cash flow, depending on the type of bank. Some banks are more conservative. Some banks are more a little looser. Point being, the bank line of credit is not sized and allocated in a fashion that is conducive to grow fast, scale, and take on all the possible work that you can possibly take. But what it is incredibly useful for are those short-term timing gaps. So a bank really appreciates consistency. If you see a company that is losing revenue year over year, maybe profitability metrics start getting a little bit skinnier, maybe your customer concentration starts getting a little bit higher, they are going to be a lot more tepid to provide the exact facility that you need in order to grow. Now, if you're growing 5 to 10% a year, everything's relatively consistent, margins are remaining consistent, you're not reinvesting a ton back into the business, as far as like infrastructure and people, they love that consistency. And honestly, banks are great for continuity. Banks are great for peace of mind on those short-term gaps. So it's like you have 3, 4, 5 jobs open and work in progress at one time, and you have a bunch of cash on those jobs taking care of materials and labor, but you have really good payers and you have really solid receivable base. That bank line of credit is perfect to help float, overhead for those 15 to 20 days until you actually get the cash starts pouring in on those jobs. But again, to just catapult growth, it's a tool, but it is not the primary tool that you'll probably use as a contractor in the lower middle market space. It is definitely a tool, but it's not the primary tool. And the cool thing about a bank line of credit, they're always going to be in first position as far as the rights they have in the event of a default. But there are a lot of solutions out there, like mobilization funding, like some ABLs, and some other products that can work really nicely with a bank line of credit in a second position. The other thing I'd like to talk about is how they collateralize themselves. Typically, banks will ask for a personal guarantee from the owner, or any owner over 20% or 25% owner of the subcontracting company. And they'll also look at they'll look at your personal net worth and say you have to fully guarantee. Sometimes they'll maybe get a mortgage on your home. If you have other companies that are underneath the umbrella of your personal ownership, that they'll make sure that to cross-collateralize and cross-default those companies, meaning If they lend to one of your companies and you default, then your other company's under default. Maybe they have a loan in company A and a loan in company B. You own both companies. If one of them defaults, then all of them default. It's just a little bit more complicated. And banks don't work super well with certain types of other financing vehicles, like factors, for example. We'll get into factors in another episode, but factors essentially buy your receivables. So you're taking receivables completely out of the borrowing base, of which you no longer own those receivables. That you sold an asset essentially at a discount to a third party. Banks kind of get a little squirrely with that too. But if I had to give you any piece of advice, even if you're not bankable now, create a solid relationship with a number of different banks. Build that relationship, continue to build that story, continue to get a better understanding of your accounts receivable base or your inventory, particularly your trading assets. If you own a building, keep up to date on sort of the marketable appraised value of that particular building. Figure out exactly what your core cash flow position is. How much EBITDA are you generating in a month, in a quarter, in a year? How does that trend over time? Be able to tell the story. I mean, the banks are really interested in knowing the story of your business. And honestly, they're looking at you in a very similar way that any other, well, not any other lender, but a lot of other lenders are going to be looking at you. They're looking at your character. What kind of person are you? They're looking at your competence. How effectively do you run your organization? What kind of collateral does your business have? What type of cash flow does your business have? If you can't answer those questions like really quickly, then your chances of getting that kind of backstop facility to help bridge those short cash flow liquidity gaps, you're putting yourself in a pretty tough position. But anyway, guys, that's the bank line of credit. I hope that helps. I mean, I kind of went at a very high level. If you have any questions, reach out to me, LinkedIn me, email me. Happy to talk you through it. But until next time, thanks for joining us.